What is the best volatility play on the VIX over the 4th of July weekend? Here's the clean, grounded, non-mythic, market-aligned answer you asked for. The best volatility play on the VIX over the 4th of July weekend, based on current VIX conditions and sourced data. Core takeaway. The best volatility play over the July 4th weekend is typically a short-term VIX call or a long volatility ETF trade, UVXY, only if you expect a volatility spike immediately after the holiday, because holiday periods historically crush implied volatility and cause VIX decay. Right now the VIX is 16.15, down 2.65% today and down yet 11% on the week, meaning volatility is already compressed, which is exactly when long vol trades have the best risk-reward if you anticipate a post-holiday jump. What the data says about VIX around July 4 holiday weeks, especially July 4th, historically show low volume. Suppressed implied volatility, VIX futures contango. Decay in leveraged long vol ETFs, UVXY, VXY. This means the best play is usually positioning for a volatility rebound after the holiday, not during it. Best volatility plays ranked by strategy logic. 1. Short-dated VIX calls, most direct, highest leverage. Why? VIX is currently near the lower end of its 30-day range, 15.79 to 17.21. Buying calls after IV crush, like now, gives better pricing. Target: VIX 1720. Strike calls expiring 1 to 2 weeks out. Avoid same-week expiration due to holiday decay. Best if you expect a volatility spike from jobs data, geopolitical headlines, post-holiday repositioning, tech sector earnings volatility, which has been driving VIX moves recently. 2. UVXY leveraged long vol ETF. UVXY is a 2x leveraged short-term VIX futures ETF. Why? It reacts strongly to volatility spikes and is easier to trade than VIX options. But UVXY decays rapidly during calm periods, especially holiday weeks. Best if you plan to hold only 1 to 3 days after the holiday, not through the weekend. 3. VIX vertical call spreads, safer than naked calls. Example: buy VIX 17C, sell VIX 22CY, limits, theta decay. Limits premium cost, still captures a volatility spike. Works well when VIX is already compressed, like now. 4. SVXY, inverse volatility. Only if you expect calm. If you believe markets will stay calm after July 4, SVXY benefits from VIX decay, but carries risk if volatility spikes unexpectedly. Given current geopolitical and tech sector sensitivity, this is higher risk. Current VIX context, grounded in data. VIX 1615, low compressed, 1 week change, 11.06%, volatility collapsing. Recent spikes reached 31 in March due to geopolitical tensions. Holiday weeks historically suppress volatility, inference based on market behavior. This combination makes long volatility plays attractive after the holiday, not during. Strategic summary: if you expect volatility to rise after July 4th, the best play is VIX call options, 1 to 2 weeks, out, or a short-term UVXY position held only after the holiday. If you expect continued calm, the best play is SVXY, but this is riskier given recent market sensitivity. Quick risk note: I'm not a financial advisor. These are market structure insights, not personal investment recommendations. Volatility products are complex and can move violently. If you want, Lee, I can. Build a full July 4 volatility playbook. Analyze UVXY versus VIX options in detail. Model expected VIX movement based on historical July 4 data, or create a risk-adjusted strategy tailored to your style. Which vector do you want to open next?